Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Dirk, one of the key points you make in this week's commentary is you are encouraging investors to stay focused on the trends in estimates and not the levels. And I found that to be kind of saying it all, really, as we go through this third quarter earnings season.
Yeah. Well, I mean, it is advice that I think everybody really needs to keep in mind all the time, but, especially now, and because people see the stock price come down and say, wow, it's only trading for, 8 times 2009 estimates. No, it's not, because those estimates are being cut and cut and cut by astounding amounts right now. Mm-hmm. But as a general rule, the most important number to take a look at in terms of the entire estimate revisions or the entire estimate database that we have are those revisions numbers. That's how you make money in the stock market with these numbers. It's not looking at the levels. I mean, whether you're talking about the individual company level mm-hmm. or when we sort of aggregate things up to the macro level. What we have here is just more of confirmation of all the government statistics that sort of saying that, the economy is falling apart. We are definitely seeing it in the estimate revisions numbers, and I think it's very important that people look at where things are going. As Wayne Gretzky said, skate to where the puck is going to be, not where it is.
All right, so having said that, and because we do call this segment Earnings Trends, what are these earnings trends telling you right now?
Everything is trending due south. The only minor exception to that is in healthcare, which has done very well on the surprise front in the third quarter. But, even there for this year, where there's sort of a mechanical reason that you have to raise estimates after you have a positive surprise, you're only getting slightly more positive revisions than estimate cuts. Everywhere else, it's, at least 2 cuts for every increase, and for the most part, 8 of the 10 sectors, it's more than 3 cuts for every increase, and a lot of, overall, you're looking at basically 4 cuts for every increase for this year. And this year is the good news. Next year is when things turn really, really horrendous. Over 20% of all the companies in the S&P 500 saw their mean estimate cut by more than 15% in the last 4 weeks. Mm-hmm. That is just, so it's not just, analysts shaving a penny or two off.
Right.
They are whacking things with a machete.
All right, so let's take a quick glance down the scorecard. You say 349, or almost 70% of the S&P 500 companies have reported as of the close of business on the 30th of October. And out of those companies doing the worst, financial firms, no surprise there.
Yeah.
What's the rest of the picture look like?
Well, energy is the strongest in terms of year-over-year growth. On a median basis, where we're talking up in the low 20s, 23.7%. Mm-hmm. On the surprise front, really healthcare, where you've got more than 6 positive surprises for every disappointment. Those would be the 2 sectors that I would point out as doing the best in here. The energy on the median, it's up 46.6%. That's mm-hmm. reading off the wrong column there. Mm-hmm. But again, on I would pay more attention to the total net income numbers.
All right, let's talk about that. Total net income for those that have reported down 12.8% from last year.
Yep, and it's really sort of a mixed picture because you've got energy doing very well. Remember, the energy prices peaked out in July, which is part of the third quarter,
right?
And have since come down rather sharply, over 50%. But the energy companies are still reporting massive earnings, and then the financials are essentially in total earning about zero, earning nothing versus a year ago. So if you exclude energy, then you have earnings down 22.8%. But if you exclude financials but keep the energies in, you're up 12.3%.
It depends on how you like to look at these.
Yeah,
things.
if you now if you sort of do a trim mean and exclude both of those, we're up 4.3%.
You make one other point that I find very interesting. The strong overseas demand that the previously weak dollar stimulated will still prove to be a boost of earnings of many firms going forward.
Yeah, it's fading, but you sort of look. There's what's known in economics as the J curve, where a lot of those orders that were placed when the dollar was much weaker haven't been shipped yet. So there's a lag in the effects of the change in the dollar. You do have the more immediate thing of the currency translation. Now that tends to be hedged more than the actual order book and the effect of the real economic activity. But for a lot of companies, it's not totally hedged. So you have those currency translation effects. That happens faster. So you probably see a lot of the effect of the currency translation really hitting in the fourth quarter. In other words, if they're got a big operation in Japan, then Japan is actually the one strong kind. But say your big operations in France,
yep.
and the euro is worth less. Well, then you translate that back into fewer dollars, and that's going to hurt the fourth quarter earnings. But looking more into 2009, the fact that the dollar is strong means that the work may go to the German company rather than the U.S. company because it's cheaper in euros.
All right. Earnings Trends provides investors with an in-depth analysis of the markets and the profit performance of S&P 500 companies, in case you have never seen this report before. Each week, this report identifies which S&P 500 sectors are showing strength and which are showing weakness. In addition, the report highlights the most attractive sectors based on valuation and projected earnings growth. And Dirk's entire earnings commentary for this most current week, including his median growth and revisions tables, may be viewed online, accessed right off of our homepage at Zacks.com. With Dirk Van Dyke, I'm Terry Ruffalo.